Hello children. Today we are going to discuss a new ratio, that is profitability ratio. First of all, let us see the classification of ratios. There are 4 categories of ratios. The first one is liquidity ratio. Second one, solvency ratio. Third one is activity ratio. And the fourth type is profitability ratio. We have already discussed the first 3 types of ratio. Today we are going to discuss profitability ratio and do some problem related to gross profit ratio. What is profitability ratio? We know that an efficiency in a business is measured by its profit. So, profitability refers to financial performance of the business. So, here are some ratios which will help us to assess the profit capacity or profit making capacity of the business. So, they are, the first one is gross profit ratio, second one operating ratio, the third one is operating profit ratio, fourth is net profit ratio, and the fifth one is return on investment, which is also known as return on capital employed ratio. Today we will discuss the first type of profitability ratio, that is gross profit ratio. The formula to calculate gross profit ratio is gross profit divided by revenue from operation into 100. The answer of gross profit ratio is expressed in the form of percentage. To calculate gross profit, the formula used are revenue from operation minus cost of revenue from operation. Children, in previous class you know very well how to calculate cost of revenue from operation. You are from the last many days you are doing the problems related to calculation of cost of revenue from operation and revenue from operations. So you are very much familiar with these terms and the formulas to calculate cost of revenue from operations as well as revenue from operation. So the formula to calculate gross profit is from our revenue, that is our sales, if you remove your cost, you will get your gross profit. So as a revision, let me tell you that cost of revenue from operation, the formula to be used is opening inventory. You have to exclude spare parts and loose tools while calculating cost of revenue from operation for gross profit ratio. Okay, so while calculating gross profit ratio, you exclude spare parts and loose tools from opening inventory plus net purchase plus direct expenses minus closing inventories. So even in opening inventory and closing inventory, you have to exclude spare parts and loose tools. Okay, so this is the formula related to cost of revenue from operation. The previous what we studied in earlier, the same formula is here, but the only thing is you have to exclude spare parts and loose tools when you calculate cost of revenue from operation for gross profit ratio. Okay, the other formula is cost of revenue, it is cost of material consumed plus purchases of stock in trade plus changes in inventories of finished goods and work in progress and stock in trade plus direct expenses. So these are related to manufacturing companies. Cost of revenue from operation formula we have to use is in this way. Okay, and the other formulas for calculation of cost of revenue from operation is revenue from operation minus gross profit if you are asked to calculate cost of revenue from operation. So these are the formulas related to gross profit ratio. Now let us do one problem. From the following information, calculate gross profit ratio. You are given the revenue from operation, that is net sales, and gross profit. 2 years amount is given to you. So you have to calculate gross profit ratio for the 2 separate period. Okay, let us first of all write the formula. Gross profit ratio is equal to gross profit divided by revenue from operation, that is net sales, into 100. For 31st March 2019, as per the formula, gross profit of that year is given to you as 40,000 and revenue from operation given to you as 1,60,000. Because the expression of gross profit ratio is in percentage, you have to multiply it by 100. After dividing it and multiplying and dividing it, you will get 25% as your gross profit ratio for the year 31st March 2019. And for the year 31st March 2020, the same thing, but the amount with 2020 you have to use. Gross profit amount for that year is 60,000 divided by revenue from operation is 2 lakh into 100, and you will get the answer as 30%. Now let us move to the next question. Following information is available for the year ended 31st March 2020. Calculate gross profit ratio. Cash sales is 25,000. Purchase, both cash and credit purchase is given separately. Cash is 15,000 and credit purchase is 60,000. Carriage inward is 2,000. Salaries is 25,000. Decrease in inventory is 10,000 and return outward 2,000. Wages is 5,000. One more information is given, that ratio of cash sales and credit sale is 1:3. That means if cash sale is 1, credit sale is its 3 times. Okay. So now we will write as usual the solution part. We will write the formula. Gross profit ratio is equal to gross profit divided by revenue from operation into 100. So children, first of all, let us find out revenue from operation. You know that revenue from operation means net sales. What are the things you are required to calculate revenue from operation? Cash sales plus credit sales. You are given cash sales, and regarding credit sales, they have given you information that credit sale is 3 times more of cash sales. So if cash sale is 25,000 into 3, if you are doing into 3, you will get credit sales. So cash sales 25,000 plus credit sales means 25,000 into 3, that will give you 75,000. Adding cash sales with credit sales, you will get the result 1 lakh as your revenue from operation. So this part of your answer is clear. Now for gross profit. Gross profit, what is the formula? Revenue from operations minus cost of revenue from operation. So for calculating gross profit, you got revenue from operation from the previous working note itself. Now for cost of revenue from operation, you have to use another formula. What is the formula? Cost of revenue from operation, that is also known as cost of goods sold, is equal to purchases plus opening inventory plus direct expenses minus closing inventory. Okay. Regarding purchase, you can see here purchase, cash purchase and credit purchase is given to you. One more item is given to you. Have you noticed? Return outward. What do you mean by return outward? It's purchase return. Okay. So add cash purchase and credit purchase and subtract return outward. So you will get the net purchase. See here, they have written it as a separate formula. Net purchase is equal to cash purchase plus credit purchase minus return outward. So doing this calculation, the net purchase you will get is 23,000. So you got purchase as 73,000. Now regarding opening inventory, children, here you are not given with opening inventory or closing inventory, but information like decrease in inventory is given to you. So what is decrease in inventory? Decrease in inventory means inventory of opening that is opening inventory is more than your closing inventory. Okay, that is what decrease in inventory means. So here what you are supposed to do is write down that amount of 10,000 decrease in inventory as it is, that is 10,000. That is what you have to do. Decrease in inventories had to be taken as it is. Okay, don't go for opening inventory minus closing inventory. That is already done, and that amount is given as decrease in inventory, 10,000. Okay, I hope it is clear. So purchases is 73,000, and opening inventory, closing inventory, they have already calculated and they have given you as a wording decrease in inventory. So that is 10,000 you have written over here, plus direct expenses. Can you find out the items related to direct expenses? Yes, carriage inward and wages. These two items are direct expenses. So add that two item. So adding all the three items, that is purchases plus, instead of opening inventory minus closing inventory, I have used the word which is given in the question, decrease in inventory, plus direct expenses. Adding this three item, I got rupees 90,000 as cost of revenue from operation. So that cost of revenue from operation I have applied in the formula gross profit, revenue from operation minus cost of revenue from operation, and after subtracting this I got the answer 10,000 as my gross profit. This 10,000 of gross profit I have written in my initial formula, that is the main formula for calculation of gross profit ratio, as 10,000 divided by revenue from operation. I got one from one of the formulas applied to calculate it, 1 lakh, that I wrote here into 100. After the calculation I got the gross profit ratio as 10%.